September 15th, 2008. Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. It was the largest bankruptcy in American history. $613 billion in debt vanished overnight. The stock market crashed. Credit froze. Banks stopped lending. Within days, the global financial system was on the verge of complete collapse. Economists warned that without immediate intervention, the world would plunge into another Great Depression. And how did we get here? Subprime mortgages, predatory lending, derivatives so complex that even the bankers selling them didn't understand them. Greed on a scale so massive it nearly destroyed the global economy. 9 million Americans lost their homes to foreclosure. 8 million lost their jobs. 17 million lost their life savings. Retirement accounts were cut in half. College funds disappeared. The American dream evaporated for millions of families. And the bankers who caused it? They got bailouts, they got bonuses, they got richer. This is the story of the 2008 financial crisis, the greatest transfer of wealth from the middle class to the rich in modern history. A crisis caused by Wall Street's reckless gambling with other people's money. A crisis that destroyed millions of lives while the people responsible faced almost no consequences. Today, we're diving into what really happened, how the banks gambled away the economy, why taxpayers had to bail out the very institutions that caused the crash, and why not a single major Wall Street executive went to prison. Because here's the truth they don't want you to remember. 2008 wasn't a natural disaster. It was a crime scene. To understand 2008, we need to go back to the 1990s and early 2000s. This is when the foundation for the crisis was laid. For decades, getting a mortgage was straightforward. You'd go to a bank, prove you had steady income and good credit, put down 20% of the home's value, and the bank would lend you the rest. The bank kept your mortgage on its books for 30 years, collecting your payments plus interest. Because the bank held the risk, they were careful about who they lent to. But in the 1990s, this model changed. Banks discovered they could make mortgages and then immediately sell them to investors, a process called securitization. They'd bundle hundreds of mortgages together into securities called mortgage-backed securities, or MBS, and sell them to pension funds, insurance companies, and other investors. This fundamentally changed the incentive structure. Banks no longer cared if borrowers could actually repay the loans because they weren't holding the risk. They were passing it to investors. All banks cared about was volume. The more mortgages they made, the more they could sell, the more fees they collected. So they started lowering standards, required less documentation, accepted lower credit scores, reduced down payment requirements. They created subprime mortgages for borrowers who couldn't qualify for traditional loans. People with poor credit, unstable income, or no income verification at all. These were called ninja loans. No income, no job, no assets. And yes, banks actually made loans to people who had literally no verifiable ability to repay them. Why would investors buy securities backed by loans to people who couldn't afford them? Because Wall Street told them they were safe. The ratings agencies, Moody's, Standard & Poor's, Fitch, were supposed to independently assess risk. They gave AAA ratings, the highest possible rating, to securities packed with subprime mortgages. AAA meant these investments were as safe as US Treasury bonds. But here's the scam. The ratings agencies were paid by the banks creating the securities. It was a massive conflict of interest. Banks would shop around for the best rating, and agencies competed to give generous ratings so they wouldn't lose business. They rubber-stamped garbage as gold. Investment banks like Lehman Brothers, Bear Stearns, Merrill Lynch, and Goldman Sachs made billions creating and selling these toxic securities. And they didn't stop there. They created even more complex derivatives called collateralized debt obligations, or CDOs, which were bundles of mortgage-backed securities bundled together and sliced into different risk layers. Some CDOs were literally made from the worst performing parts of other CDOs. They were called CDO squared. It was toxic waste packaged as investment-grade securities. And then Wall Street invented credit default swaps, essentially insurance policies on these securities. If the mortgages defaulted, the insurance would pay out. Companies like AIG sold billions of dollars in credit default swaps, collecting premiums and assuming they'd never have to pay claims because housing prices always go up, right? Except housing. Prices don't always go up. Meanwhile, mortgage brokers were making a fortune. They'd convince people to take out mortgages they couldn't afford by offering teaser rates, low introductory interest rates that would balloon after 2 or 3 years. They'd tell borrowers not to worry because they could refinance before the rate increased, or the home's value would rise and they could sell for a profit. It was all built on one assumption: housing prices would keep rising forever. Families were taking out mortgages with payments they couldn't afford, planning to refinance in a year or two. Speculators were buying multiple properties with no money down, planning to flip them. Everyone was convinced they'd get rich on real estate. From 2000 to 2006, housing prices doubled in many markets. Everyone was making money: banks, brokers, investors, homeowners. It felt like a perpetual money machine. But it was a bubble, and bubbles always burst. In 2006, housing prices peaked and started to fall. Just a little at first, barely noticeable, but it was enough to trigger disaster. Remember those adjustable rate mortgages with teaser rates? They started resetting to higher rates. Suddenly, families who'd been paying $1,200 a month were facing $2,500 monthly payments. They couldn't afford it. They tried to refinance, but their homes were now worth less than what they owed, a situation called being underwater. Banks wouldn't refinance underwater mortgages. So families had two choices: continue making payments they couldn't afford, or default. Millions defaulted. Foreclosures skyrocketed. By 2007, foreclosure filings were up 75% from the previous year. Entire neighborhoods were abandoned. Housing prices fell further, creating a downward spiral. The mortgage-backed securities that had been rated AAA started failing. Investors realized they'd been sold garbage. They tried to sell, but there were no buyers. The market for these securities froze. Banks that had invested heavily in mortgage-backed securities started posting massive losses. In March 2008, Bear Stearns collapsed and was sold to JP Morgan Chase for pennies on the dollar in a government-brokered fire sale. Then the dominoes really started falling. In September 2008, the government took over Fannie Mae and Freddie Mac, the giant mortgage companies that owned or guaranteed about half of all US mortgages. Cost to taxpayers: $187 billion. Days later, Lehman Brothers filed for bankruptcy. The government let Lehman fail, thinking the market could absorb the shock. They were catastrophically wrong. Lehman's collapse triggered panic. Banks stopped trusting each other. If Lehman could fail, anyone could fail. So banks stopped lending, even to each other. Credit markets froze completely. Companies that depended on short-term loans to make payroll couldn't get credit. The commercial paper market, where companies borrow for daily operations, seized up. Businesses couldn't function. The next day, the Federal Reserve had to bail out AIG with an $85 billion loan, later increased to $182 billion, because AIG had sold so many credit default swaps on failing mortgage securities that its collapse would have destroyed the entire financial system. Then, Merrill Lynch was sold to Bank of America in an emergency deal. Washington Mutual failed, the largest bank failure in US history. Wachovia nearly collapsed and was bought by Wells Fargo. Within 2 weeks, the entire financial system was on life support. Treasury Secretary Henry Paulson, former CEO of Goldman Sachs, and Federal Reserve Chairman Ben Bernanke went to Congress with a terrifying message. Without immediate action, the entire global financial system would collapse within days. ATMs would stop working. Paychecks wouldn't clear. The economy would enter a depression that would make the 1930s look mild. Their solution? a $700 billion bailout package called the Troubled Asset Relief Program, TARP. Taxpayers would give money to the banks that had caused the crisis. Congress initially rejected it. The stock market dropped 777 points in a single day, the largest point drop in history at the time. Facing economic apocalypse, Congress passed a revised version. On October 3, 2008, President Bush signed TARP into law. The government would inject $700 billion into the financial system to prevent total collapse. Here's where it gets infuriating. The banks that had gambled recklessly, that had created and sold toxic securities, that had crashed the global economy, they got rescued with taxpayer money. Goldman Sachs received $10 billion. Morgan Stanley got $10 billion. JP Morgan Chase got $25 billion. Citigroup got $45 billion. Bank of America got $45 billion. And what did they do with this money? Money that was supposed to stabilize the economy and get credit flowing again. They paid bonuses, billions of dollars in bonuses. In 2008, Wall Street firms paid out $18.4 billion in bonuses. The financial sector had just received the largest taxpayer bailout in history. The economy was in free fall. Millions were losing their homes. And bankers paid themselves nearly $20 billion in bonuses. The justification? They needed to retain top talent. Without competitive bonuses, the best employees would leave for other firms. This argument is obscene. Where would they go? The entire industry had collapsed. Every major bank was either bankrupt or on government life support. But Wall Street managed to convince the government that paying massive bonuses during a taxpayer-funded bailout was necessary. Meanwhile, ordinary Americans were drowning. Unemployment hit 10%. Families were living in their cars after foreclosure. Retirement accounts were decimated. College funds evaporated. And the government's response to homeowners? Minimal. The Home Affordable Modification Program, HAMP, was supposed to help struggling homeowners modify their mortgages. It was a disaster. HAMP was voluntary for banks, and they had no incentive to participate. The program helped fewer than 1 million homeowners, a fraction of the 9 million who lost their homes to foreclosure. Banks often strung homeowners along with promises of modification, then foreclosed anyway. Some foreclosed on active duty military members, which was illegal. Others foreclosed on people who'd never missed a payment due to paperwork errors. The contrast was stark. Billions for banks, almost nothing for homeowners. And here's the part that should make your blood boil. The bailouts didn't just save the banks, they made them bigger and more powerful. Before the crisis, the 6 largest banks controlled 17% of US financial assets. After the crisis, when small banks failed and were absorbed by larger ones, the big banks controlled 30%. They became even more too big to fail. JP Morgan Chase bought Bear Stearns and Washington Mutual. Bank of America bought Merrill Lynch and Countrywide. Wells Fargo bought Wachovia. The crisis concentrated power in fewer, larger institutions. And these megabanks are now even more dangerous than before, because everyone knows that if they fail, the government will bail them out. It's called moral hazard. When someone is protected from the consequences of their actions, they take bigger risks. The government tried to prevent future crises by passing the Dodd-Frank Wall Street Reform Act in 2010. It created new regulations, stress tests for banks, and a process for winding down failing institutions without taxpayer bailouts. But Wall Street immediately began lobbying to weaken it. Over the following decade, many provisions were rolled back or never properly implemented. The Consumer Financial Protection Bureau, created to protect consumers from predatory lending, has been constantly under attack. Now let's talk about accountability, or rather, the complete lack of it. After the savings and loan crisis in the 1980s, more than 1,000 bankers were prosecuted and sent to prison for fraud. After the 2008 crisis, one major banker went to prison, Karim Sarageldin from Credit Suisse, for hiding losses. He served 30 months. Not a single Wall Street executive from the major American banks went to prison for causing the worst financial crisis since the Great Depression. Why not? The government claimed it was too difficult to prove criminal intent. Banks paid civil fines, billions of dollars in settlements, but these were corporate penalties. The executives personally faced no criminal charges. Let's look at some specific cases. Countrywide Financial, run by Angelo Mazzillo, was one of the largest subprime lenders. They made loans they knew borrowers couldn't repay. Internal emails showed executives calling their own loans toxic and predicting they'd fail. Mazzillo personally made $470 million selling Countrywide stock while the company collapsed. His punishment? A $67.5 million fine in a civil settlement, paid largely by Countrywide's insurance, not by Mazzillo personally. No criminal charges. Dick Fuld, CEO of Lehman Brothers, made over $500 million during his tenure while steering the company into bankruptcy. No criminal charges. Lloyd Blankfein, CEO of Goldman Sachs, presided over a bank that created toxic CDOs, sold them to clients while calling them junk internally, then bet against those same securities. Goldman made billions while their clients lost everything. Blankfein personally made $68 million in 2007 alone. Goldman paid a $550 million settlement with the SEC. Blankfein faced no charges and kept his job. This pattern repeated across Wall Street. Civil settlements with no admission of wrongdoing. Corporate fines that sounded large but were small compared to profits. No executives in handcuffs. Compare this to how the Justice Department treats ordinary criminals. A person caught with drugs goes to prison for years. A person who robs a bank of $5,000 gets a felony conviction. But bankers who defrauded investors of billions, who crashed the global economy, who destroyed millions of lives, they paid fines and moved on. The message is clear. If you steal a little, you go to prison. If you steal billions, you're too important to prosecute. The Obama administration, which came to power in the midst of the crisis, failed to hold anyone accountable. Attorney General Eric Holder literally said that some banks were too large to prosecute because criminal charges might destabilize the financial system. Read that again. We can't prosecute criminal banks because it might hurt the economy. So the banks that were too big to fail were also too big to jail. This created a two-tiered justice system, one for Wall Street, one for everyone else. Meanwhile, the human cost was staggering. Studies showed increased rates of suicide, domestic violence, and stress-related illness during the foreclosure crisis. Families were torn apart. Communities were destroyed. The wealth gap widened dramatically. The rich got richer, while the middle class lost a generation of accumulated wealth. And what did America learn? Not much, apparently. Today, many of the regulations passed after 2008 have been weakened. Banks are bigger than ever. Wall Street compensation is back to pre-crisis levels, and the same risky behaviors that caused 2008, excessive leverage, complex derivatives, conflicts of interest, continue in different forms. We're told the system is safer now. That stress tests and capital requirements prevent another crisis. But the fundamental problem remains. Banks can privatize profits and socialize losses. When they win, they keep the money. When they lose, taxpayers cover it. The 2008 financial crisis wasn't a random event. It wasn't a natural disaster. It was the inevitable result of a system designed to reward recklessness and protect the powerful. Banks made risky bets because they knew they wouldn't bear the consequences. Ratings agencies gave AAA ratings to garbage because they were paid by the banks. Regulators looked the other way because they came from Wall Street and would return to Wall Street. Politicians enabled it because Wall Street funded their campaigns. And when it all collapsed, who paid? Not the bankers who got rich creating toxic securities. Not the executives who collected hundreds of millions while their firms failed. Not the ratings agencies that lied about risk. Taxpayers paid, homeowners paid, workers paid, the middle class paid. And the people who caused it? They're fine. They're wealthy. They faced no criminal penalties. Some are still running major financial institutions. Others are giving speeches for six-figure fees or serving in government. This is the greatest scam in modern history. Convince people that a crisis caused by elite financial institutions requires those same institutions to be rescued by ordinary people, then face no consequences for causing the crisis in the first place. 16 years later, what's changed? Some regulations, mostly weakened. Some oversight, mostly captured by the industry it's supposed to regulate. Some new rules that banks lobby to eliminate. The banks are bigger. The wealth gap is wider. And another crisis is inevitable because we never fixed the underlying problem. A financial system that rewards gambling with other people's money and protects the gamblers from consequences. The 2008 crisis taught us that banks are too big to fail, executives are too big to jail, and ordinary people are too small to matter. Unless we demand change. Unless we support politicians who will break up the mega banks, enforce regulations, and prosecute white-collar crime as seriously as street crime. Unless we remember what happened and refuse to let it happen again. Because they're counting on us to forget. They're counting on the passage of time to erase the anger, the pain, the injustice. Don't forget. Don't forget the 9 million families who lost their homes. Don't forget the 8 million who lost their jobs. Don't forget that not one major Wall Street executive went to prison. Don't forget that the banks got bailouts and bonuses while homeowners got foreclosures and bankruptcies. Don't forget that the game is rigged, the system is broken, and nothing will change until we force it to change. The 2008 financial crisis was a crime. The bailouts without accountability were a travesty. And the fact that we've learned so little is a tragedy. Next time, and there will be a next time, whose side will you be on? 9 million lost their homes. 0 Wall Street executives went to prison. If this video reminded you why we can't let them forget what happened, smash that like button and subscribe. We're exposing the truth about financial crimes they don't want you to remember. Comment below. Do you think another 2008-style crisis is inevitable? What scandal should I investigate next? Your voice matters. Thanks for watching, and never forget who really paid for Wall Street's greed.